I'm going to share with you the most successful stock market investing strategy in the world. It's the same stock market investing strategy that Warren Buffett, one of the most richest people in the world, uses. He also recommends other investors to use it as well. It's also the same investing strategy that Stephan recommends, who's one of the most popular investing YouTubers around. And this investing strategy is 90% more successful than any other type of investing you could do. That means that this specific investing strategy outperforms any of those people who went to Harvard or Yale and get paid millions of dollars a year to manage mutual funds. It's 90% more successful than them, or any of the day traders who sit in front of 5 monitors and look at the charts and numbers. It's 90% more successful than them as well. And personally, it's my favorite investing strategy as well. So if I haven't hyped it up enough for you, I'll let you know exactly what it is. It's called an ETF, Exchange Traded Fund. If you have no idea what an ETF is, in this video I'll break down exactly what an ETF is, how to get started investing in ETFs, and I'll show you the exact math of how you could turn $100 into $10,000 with this investment strategy. First, let's break down what is an ETF. If you're not familiar with the stock market or investing, in this video I'm going to make it as easy to understand as possible, as if you've never heard of any of these terms before. I'm going to use common terms first, and then I'll use the proper investing terms later. This way you don't get confused with investing jargon, so I'll just keep it really simple for you to understand. Before I explain exactly what an ETF is, it's important you know the fundamentals first. So let me talk about the stock market and stocks first, and then I'll get into what an ETF is. So you may have heard of stocks or the stock market. There are popular companies such as Amazon, which has a stock price valued over $3,000, or Facebook, Google, Microsoft, Tesla. They have stock prices that keep going up because the company's value and the company's success keeps going up as well. Traditionally, what a lot of people do when they invest in the stock market is they pick an individual stock of a company. So if they see a company that they think is going to be successful over time and they think that stock price is going to go up, they buy a share of that company. Basically, they're buying a piece of that company, hoping that that company gets successful, and the share that they buy, the stock price, it goes up and up and up. Therefore, their money appreciates in value. And then let's just say they buy the stock at $100, and then in a year from now, it goes up to $200. Therefore, that person made a $100 profit if they sell that share of the stock. They cash it out and put it in their bank account. There are two issues when investing in individual stocks or companies. One is that most people have a lottery mindset. So for example, with Amazon, people are constantly looking for that next stock where they could buy for $50, $100, $200, and then it'll go up to $3,000 like Amazon. So people are just kind of guessing or betting and hoping that whatever stock they buy is going to go up $1,000, $2,000, $3,000. The problem with that strategy is that 90% of the people have no idea what they're doing, and they may invest in a company for the wrong reasons. Which brings me to the second issue with individual stocks, is that most people don't do their homework before investing in an individual stock. The people who are really serious stock investors, they listen to the earnings call, which is every quarter. They may have a call that anyone could listen to who's a share owner, and they talk about their future plans. Not a lot of people want to put the time and energy into listening to an earnings call, or look at the balance sheet and make sure that the numbers are correct, that they're not going to go in debt in a year or two and their stock price might plummet, or look at other factors. The majority of people pick a certain company that they think is going to be successful over time, and they invest their money in it, hoping that it'll go up, which is the majority of what people do in general, but they may not be investing for the right reason. Investing in individual companies can be risky. You could have a great return, meaning like a stock like Amazon where you buy it for a few $100s and it goes up to $3,000 and you make a ton of money off of it, or the amount of money you invest in it goes nowhere and it completely drops. So when investing in individual stocks, the rewards can be high, but the risk is high as well. So it all depends on a person's risk tolerance. Now let's talk about what an ETF is. So an ETF, Exchange Traded Fund, to keep it really simple so that you'll understand, it's basically a group of certain stocks. What this means is a ETF could have a dozen, could have 100, it could have 500, could have 1,000 different companies all collectively in one group packaged up at one price. The benefit of an ETF is that if you have a group of companies, so let's just say you have a bucket of multiple different companies, if a few of those companies are not performing properly and their stock price is going down, it's okay because you have a few hundred other companies that are doing well that'll make up the difference. So I'm filming this video in July 2020, and we've had a lot of crazy times the past few months. A lot of companies went out of business and bankrupt. Therefore, if you own an individual stock of a company that goes bankrupt and their stock price goes down to zero, whatever amount of money you invested in that company, you now have $0. Compared to an ETF, what they could do is if they have companies that are going out of business, they could just drop those companies out of the ETF and replace them with more successful ones. So by investing in an ETF, you are protected by multiple companies compared to just investing in one. The downside of investing in an ETF is that you're not gonna hit a home run. So if you put $100 in an ETF, it's not gonna be like Amazon where it shoots up to $3,000 over a few years. ETFs have slow upward growth, and which is okay because you don't want to go for the get rich quick schemes of stocks because with the high risk comes high loss. So now let's talk about a real life example of an ETF, and it's actually my favorite ETF. It is SPY, which is the ticker symbol. A ticker symbol could be anywhere from 1 letter to 4 letters that represents a company in the stock market. Rather than writing the whole company out, they just have these letters to represent the company. So the ETF SPY, which represents the S&P 500. The S&P 500 is basically 500 of the largest US companies all bundled into one group, an ETF labeled SPY. Some examples of the top performing companies that is in SPY is Microsoft, Apple, Amazon, Google, Facebook, and also Berkshire Hathaway, which is Warren Buffett's own company. So by investing in SPY, you are basically investing in those companies as well as hundreds of other successful companies. By the way, I'm David, and if you want wise money tips to build a wealthy future, subscribe to the channel for more videos like this. And if you appreciate the time, energy, and research that goes into making this video, hit the like button. Now let's talk about the track record of the SPY and why Warren Buffett recommends this to the majority of investors who are just beginning or just even the average investor. I don't want to confuse you too much, and I don't want to use too many terms in this video. I just want you to understand the basic concept. But the S&P 500 itself is considered an index fund, and the ETF, the exchange traded fund labeled as SPY, represents that index fund of the S&P 500. So if you invest in SPY, basically you're investing in the S&P 500. So I want to show you this chart right here of SPY. So it was born July 18th, 1980. It's actually 40 years old because I'm filming this July of 2020. So if you bought this at $122, and this represented the 500 most successful companies back then it was slowly going up. As you can see, there are certain blips, but over time it's been an upward trend. And around these certain dips is when the whole market crashed in general. This was the dot-com burst. This was when the housing crisis happened. And as you see though, it's been a slow upward trend. So from 1980 up until now, it's been a historical average return of 10% per year. So some years it could have been 5%, other years it could have been 15% return, but over the course of these years, it was a 10% return. So that means if you invested in the S&P 500 today, over the course of 5, 10, 15, 20 years, or however long, it'll have a historic average return of 10%. That means if you put $1,000 into it, you'll receive $100 in return as 10% return. Before I show you exactly how you can invest in this ETF and you can make money of it over the long term, as well as show you that math of how to turn $100 into $10,000, I want to share with you one more example of why an ETF is better than an individual stock. So in mid to late March, the entire stock market just took a 30% dip. The reason why is because of the pandemic, the crisis, the virus, all that. A lot of people didn't know what was going on, and since the stock market runs off of emotions, a lot of people were uncertain, and so they were holding their money. A lot of them sold off a lot of their stocks because they were afraid of what was going to happen. And because not a lot of people were traveling, a lot of people saw an opportunity in investing in airlines such as Delta Airlines, United Airlines, American Airlines. So those are three legacy airlines of the United States. Since all flights were more or less canceled, no one was going international, borders were closed, the stock market, the prices of those airline companies dropped significantly as well. So a lot of people, including myself, saw the opportunity there and bought American Airlines, Delta, and United Airlines at these low prices because everyone kind of figured that after a certain amount of time, the virus will go away and then people will start to travel again. Now, we're in July and flights have been banned to Europe, and these airline companies are hurting a lot. And there's speculation that maybe some of these companies may go bankrupt. If they go bankrupt, whatever money you put into the stock, and if the stock goes down to zero, you basically lose your money. Besides the ETF SPY, which is for the 500 largest US companies, there are so many other ETFs. There are ETFs for the real estate market, which has a group of different companies that are involved in real estate. Or if you want to invest in just technology companies like Google and Facebook, there's an ETF just for that. But more specifically, there's an ETF, JETS, that represents US airlines as well as international airlines, all grouped together in one ETF. So if a few of those airlines go bankrupt, at least you are protected by multiple other airlines just in case something happens. So personally, rather than investing a lot of money into individual airlines, I personally think it was a better idea to invest in the ETF JETS, which represented multiple airlines, just in case a few of those airlines went bankrupt. So if we look at this chart here, this is the ETF of JETS. As you can see, it's been hovering around $29, $30. And then when the pandemic started and no one knew if they were going to travel again, it dropped down to $13, $12, and currently it is at $16. So in my opinion, I think this would be a good investment now because once travel eventually in our lifetime happens again, this will go up. So if a few airlines actually go bankrupt, at least with the ETF JETS, you have a few dozen other airlines that can make up the difference. So now that you understand the benefits of what an ETF is, what the benefits are, and why it's 90% more successful than investing in mutual funds or day trading strategies, I'm going to show you exactly how you could purchase your first ETF today and start investing. So if you click the link down in the description below to Robinhood, you get a free stock just for signing up. I get a free stock as well. I'm going to show you this example on my phone on Robinhood, how you could purchase an ETF. So assuming you already have Robinhood set up, I have a link down in the description below of how you could set up Robinhood. Assuming you have that all set up, we're going to go to the profile, and then we're going to click the magnifying glass at the bottom. We're going to click SPY. And that's it. So right now it's valued at $319. If you don't have $319, we could do less than that. So I'm going to click trade. And what I'm going to do is something called fractional shares. So if you have Robinhood, you could just set up the fractional shares option and you could buy pieces of shares. So in this example, I'm going to buy in dollars. And let's just say I only have $10 to invest right now. I'm going to click 10, review, and then I'm going to swipe up. And now the order is complete. I just bought $10 worth of shares with SPY, which is 0.03 shares. So if you just have a little bit of money to invest, it's better than investing anything. Also, this is where I want to put in the disclaimer. I am not a professional personal finance advisor. This is just for entertainment purposes only. Now let's do the math and I'll show you exactly how you could turn $100 into $10,000 and how long it would take. So if you were to invest in the ETF SPY, which is giving a historical average of a 10% return. So let's just assume you're going to get 10% for every year until it turns into 10,000. So if you were to start with this, if we look at this investment calculator, you start with $100 and you're getting a 10% return, and you're doing $100 every month, it would take you 6 years and 1 month to get $10,066. You would put $7,300, and your interest earned would be $2,666 for not doing a single thing. And if you want to watch a short playlist of investing videos like this for beginners, you could click this playlist right over here up top. And if you want to get started with Robinhood and learn how to buy your first stock, how to set it all up, you could click the video down over here, and I'll see you in the next video.